Welcome back to the Privatized Banking Project. Have you ever thought bonds could be your ticket to long-term financial security? Today, we're exploring what bonds are and how they work. By the end of this video, you'll understand their importance in investing. Let's start with the basics. A bond is essentially a loan. When you buy a bond, you're lending money to a government or corporation. In return, they pay you interest regularly and eventually return the principal amount. It's straightforward. Lend money, receive interest, get your money back. Bonds often provide more stability compared to stocks. However, they're not entirely risk-free. Now, let's explore the different types of bonds. Government bonds, like the U.S. Treasuries, are among the safest investments. They're backed by the U.S. government's credibility. These bonds come in various terms, from a few months to 30 years. Next, we have municipal bonds, issued by state or local governments. These often offer tax advantages, especially for residents of the issuing state. For higher income earners, tax-free income is a significant advantage. Then there are corporate bonds, issued by companies to raise capital. While they typically offer higher returns than government bonds, they come with increased risk. If the company falters, you may lose your investment. Each bond type serves a different purpose. Key is finding out what aligns with your financial goals and risk tolerance. Now, let's discuss interest rates. Bond prices have inverse relationship with interest rates. When rates rise, bond prices usually fall. For instance, if you bought a bond at 2% and new bonds are at 5%, your bond's value drops. That's why understanding duration is vital. Duration indicates how much a bond's price will fluctuate with interest rate changes. Longer duration bonds are more sensitive to rate shifts than shorter ones. How do you assess a bond's risk? Look at the credit rating. Agencies like Moody's, S&P, and Fitch evaluate bonds based on the issuer's financial stability. Investment-grade bonds are safer than those rated below that threshold, known as junk bonds. Next, consider yield to maturity, or YTM. This reflects the annual return if you hold the bond until maturity, including the purchase price and interest payments. It gives a clearer picture than just the coupon rate. Let's discuss a myth. Bonds aren't just for retirees. They can benefit investors of any age. Especially in unstable markets, they preserve capital and reduce volatility. For example, if you're 35 with a 70-30 stock bond portfolio, bonds can cushion the blow during market dips. They may not spike in value, but they help maintain your investment's worth. Finally, bonds aren't fixed. You can buy individual bonds or invest in bond ETFs or mutual funds for diversification. The downside? With funds, you lose control over maturity dates, but you gain diversification and professional management. So remember this, bonds are not boring. They offer control, stability, and a unique financial freedom. Understanding bonds can help you build wealth over time and ensure peaceful nights. If you found this video helpful, hit like, subscribe, and share it with others working on their investment strategies. Let us know in the comments. Are you currently using bonds, or is this your first introduction? At the Privatized Banking Project, we focus on building financial knowledge for real freedom.